Every headline you look at is talking about the yield curve and recession.
Given the yield curve inversion,
we inverted back in March. Yes, we now have an inversion.
Even if the yield curve inversion happens again and happens persistently.
But what is the correlation, and can the yield curve actually predict a recession? What we know so far is that the Federal Reserve has raised interest rates 11 times since March 2022 and decided to pause yesterday in their September 20th meeting. And let me make that clear. This is a pause and not a stop, because according to the CME tool, there is still a chance they increase one more time this year, either in their November or December meeting.
We have to remember the 2023 dot plot and just the signal that they keep that one extra hike in there, which is highly likely because of the resilience that we've seen in the economy in the data.
Yeah.
The Fed's goal in all of this is to slow down the economy and combat inflation. But in the process of all of this, this has caused an inversion in the yield curve. But what's the big deal, and should we be worried? Hello and welcome to UKash Finance, and yes, that is my real name. If you enjoy content like this, hit that like and subscribe button. Think of the yield curve like a snapshot of how much money you can make by lending your money to the government for different lengths of time. Or in other words, the interest rates return or yield on bonds or loans with various maturity dates.
The yield curve is just a graph showing the relationship between short-term and long-term interest rates of U.S. Treasury notes.
Under normal economic circumstances, the curve goes upwards, meaning shorter-term bonds offer lower return to investors and longer-term bonds offer more of a return. This makes sense because holding an investment for a shorter duration carries less of a risk.
Usually the short-term rate is lower than the long-term one. But if you are lending money to the federal government, which is essentially what happens when you buy a treasury note, you are taking a bigger risk by letting the government have your money for a longer period of time. So you're going to want a higher interest rate to compensate you for taking on that risk.
In general, when we talk about the yield curve frequencies, the popular ones are the 2-year, 10-year, and 30-year. When the curve goes in a downward trend or an inverted curve, this means you can actually earn more with short-term bonds rather than long-term bonds. Now, this might sound nice and dandy, but when this happens, it can indicate that there is a crisis headed for the economy.
If the long-term rate dips below the short-term rate, that's what we call an inverted yield curve. And the market is concerned about it.
The last time the yield curve inverted was in May 2019. And in February 2020, the US entered a recession. Granted, it only lasted 2 months thanks to the Fed printing trillions of dollars. In fact, the 2 and 10-year yield curve has acted like a crystal ball before every recession since 1955, with one exception where it offered a false signal. And to go even further, the yield curve has inverted 28 times since the 1900s. And out of those 22 times, a recession happened afterwards. During the last 6 recessions, the recession typically started about 6 to 36 months after the yield curve inverted. And in this business cycle, the 2-year and 10-year Treasury yield officially inverted for the first time in July 2022 since 2019. Now, does this mean we should sell all of our stocks? Looking at data since 1978, history shows that on average, it takes around 15 months for the economy to slip into a recession after the yield curve inverts. If we use this historical pattern and apply it to the most recent inversion, it suggests that the economy might potentially enter a recession around October of this year at the earliest. Now, before you click that sell button, think of this indicator as only a suggestion and not a rule. But why does an inverted yield curve signal a recession in the first place? Well, one explanation is that it slows bank lending activities. Banks make money by doing 2 things. First, they take the money you deposit in your account, and second, they lend that money to others who need it for things like buying a house, car, or expanding their business. The bank generates profit as long as they earn more than what they paid you for keeping your money in your account. But since rates are so high, the bank has to pay you more for depositing your money with them. And as a result, they have to charge higher interest rates to borrowers in order to generate a profit. But with higher rates, this discourages borrowing, and as a result, people and corporations cannot expand their businesses or take on new risk due to lack of capital, and as a result, eventually lending to a slowdown in the economy.
It becomes more expensive to borrow for the short run than in the long run. All of this affects how people lend and the risks they're willing to take. That can help drive a recession.
Now, this video wouldn't be complete without me talking about the economists who think that this time might be different with the inverted yield curve. In the most recent poll of economists conducted by the National Association for Business Economics, over 66% of those surveyed expressed confidence in the Federal Reserve's ability to guide the U.S. economy to a soft landing, while only 20% of respondents believing that the United States will enter into a recession within the current year. Companies like Goldman Sachs, Bank of America, and Chase have decreased their probability of a recession from 20% down to 15%.
Got JP Morgan's weekly economic report, and they are calling off their recession forecast for this year.
All in all, the yield curve inversion is not a crystal ball for a recession. The facts we know for sure are that the Fed's fund rate is at 5.5%, which puts more pressure on the economy in terms of economic expansion. And the Fed is still considering one more rate hike to make sure inflation does not make a comeback.
So how many more rates are actually being, thought of being priced in for the rest of the year? If it's more than one, I think the market pulls back immediately and we go back into worrying about whether or not, there will be a recession.
All I am doing for now is having my long-term positions in the S&P and in Bitcoin, and have a heavy cash position to take advantage if the opportunity presents itself. Only time will tell. If you found value in this video, make sure to share, and most importantly, stay informed, stay rich, and stay subscribed. Thank you very much, and I'll see you next time.